You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me once again in the studio today is my colleague, Matt Cashman, a 20-year options veteran with roles ranging from market maker and risk manager, among others. And now, lucky for us, a fellow options instructor here at OIC. Matt, welcome back.
Thanks, Mark. I'm really happy to be here, and thanks for the warm intro.
Yeah, certainly. Matt, for today's podcast, I wanted to revisit a discussion that you and I had last week when we were talking about options pricing and the effect dividends can have on that pricing. And since you're going to be presenting an OIC webinar on this very topic, I was hoping you could help shine a light on dividends. What are they, how they affect options pricing, and how they influence the potential for early exercise. Sound good?
Sounds good to me. Let's do it.
Before we really dive, listeners should be aware that the first part of today's conversation will focus on regular or ordinary dividends.
All right, great. So let's start off with a little bit of research that I was doing this morning. And I thought that I'd put you to the test right off the bat, as I know you're a history buff. So, Matt, tell me, where and when did dividends originate?
That's a really good question, Mark. Thanks for putting me on the spot. The short answer to that question is that dividends originated where the first payable dividend was paid by the Dutch East India Corporation starting in 1602. So, wow. Yeah. They paid dividends for about 200 years. Let's start with really what dividends are in its simplest form. So a dividend in its most simple form is just a distribution of profits by a corporation to its shareholders. Mm-hmm. When a corporation earns a profit or has excess or surplus, they're able to pay that proportion of their profits as a dividend to shareholders in some way, shape, or form. It's essentially a way for corporations to say thank you to their shareholders for basically loaning them the money to do business. And like I said, as far as a very brief history, the Dutch East India Company, always a tongue twister, was the first recorded public company ever to pay a regular dividend. The VOC paid an annual dividend worth about 18% of the value of the shares for almost 200 years straight. So from 1602 to 1800. Now,
I was just going to say, wow, a 200-year track record, impressive.
Yeah, that's something that we don't have in our modern ecosystem, certainly. But that practice has since morphed into the current dividend environment that we see today, where dividends can take lots of different forms. Cash dividends are the most common form of payment. They're paid in currency, usually with either an electronic funds transfer or a printed paper check. Generally, for each share owned, a declared amount of money is distributed. Thus, if a person who owns 100 shares and the cash dividend is 50 cents, their proportion of the dividend is going to be around $50.
Okay, makes sense.
So different classes of stock also have different properties when it comes to dividends. So preferred shares and common shares are obviously different. Well, preferred shares, theoretically, are supposed to be paid dividends first before common shares are. So you'll see a lot of time when dividends are paid, they go to preferred shareholders first, and then they filter down into common shareholders. Stock or scrip dividends can be paid out in the form of additional shares of the issuing corporation, or sometimes they can be, in the case of something which we would refer to as a spinoff, can be a different corporation that a company has started and is paying through a distribution of shares in that. They're usually issued in proportion to the shares owned. So for every 100 shares of the stock owned, if a company were to pay a 5% stock dividend, if you owned 100 shares of it, you would get 5 extra shares, right?
Okay,
5%.
right. Makes sense.
Yeah, as far as the history goes, though, the Dutch East India Company was the first, and they paid a dividend for almost 200 years, which is pretty cool.
Right. Oh, absolutely. All right. So we had a bit of a history lesson, and we've got an explanation of what dividends are and some different forms of them. Let's go ahead and get into some of the more useful concepts and terminology, specifically dates and terms such as record date, ex-dividend date, etc. So let's get into what those dates mean and why they're so important for investors.
Yeah, absolutely. Those two terms are really the kind of most utilized.
It's the crux of dividend, right?
Exactly. Those are the terms that really, when you're talking about it, especially as either an option holder or a stockholder, those are the dates that you're really going to want to pay attention to, those two dates. And they are, like you said, the record date and the ex-dividend date. The record date is the date when a company will essentially take a picture of their stock ownership ledger, and shareholders that are registered in the company's record as of that record date will be paid the dividends, and shareholders who are not registered as of that date will not receive the dividends.
Okay.
So you can imagine that's a really important date, right? You want to know what date you need to own the stock by in order to get the dividend. Now, registration in most countries is essentially automatic for shares purchased before the ex-dividend date, which is the next date that we're going to discuss, right? Generally speaking, if you own shares in a publicly traded company that is paying a dividend, you don't have to ring them up and remind them that you're on the ledger. You're on the ledger already, and the actual record date is the date at which that will come to fruition, and you will be a record date shareholder and thus pay the dividend. Now, the next date that we care about, really, where the rubber meets the road, is the ex-dividend date. Now, it's called the ex-dividend date because this is the date on which the shares bought and sold no longer come attached with the dividend. They no longer come attached with the right to be paid the most recent dividend.
Right.
In the United States and many European countries, it's typically one trading day before the record date, generally speaking. Not always, but that's generally how it works. So this is an important date for any company that has a lot of shareholders, including those that trade on exchanges, to enable reconciliation of who's entitled and who's not entitled for the dividend. So existing shareholders will receive the dividend even if they sell their shares on or after that date. Now, anyone who bought the shares will not receive that dividend. It is an ex-dividend share transaction. So it's relatively common for a share price then to actually decrease on the ex-dividend date by roughly, this is a method of supply and demand as well, right? Price discovery, but it usually is common for the stock price to decrease on ex-div by the amount of the dividend.
Right.
And what that does, right, is it roughly reflects the decrease in the company's assets resulting from them paying that dividend to all of their shareholders.
Okay, which segues great into our next topic. So if the stock price is typically going to drop by the amount of the dividend on the X date, because those shares no longer carry the right to the dividend, then the option contracts would be priced accordingly because, for example, if you were buying a call, you no longer have the right to exercise that call to take advantage of the dividend. So aside from stock price, strike price, time till expiration, implied volatility and interest rates, dividends are one of those options pricing components. So let me ask you, keeping in the same vein of the ex-div date and how the options no longer carry the right to that dividend, how major of a role does dividends play in pricing options?
Yeah, that's a really good question. And, it's funny, aside from all of those other factors, right, that we factor into all of how options are priced. Now, like options are obviously very complicated pieces of, they're leveraged and they're, and they are securities that are complicated. They're complicated in lots of different ways. Many of those things that you discussed, that you just listed, are the things that go into an options valuation, but a dividend is in there as well. And it's on the list of all of those things. It plays a pretty big role. And sometimes those dividends can be large numbers, right? Sometimes they can be, it's not uncommon for companies to pay dollars worth of dividends. And it's something that you need to consider when you're looking at options and how they're priced, because you need to consider it, like think about it this way. An option that contains the right to convert into a long underlying position through the process of exercise that you just said, is going to have a completely different valuation than an option that doesn't contain that right. Consider a circumstance where, especially surrounding those dates that we discussed, the X day and the record date, those options that include the right to exercise and create a long stock position that receives the dividend are going to be different in value by roughly, guess what? The amount of that dividend, right? Because people factor that into how much they're willing to pay for or sell those options for in that price.
Right, and not only that, but if you look at stock XYZ that doesn't pay dividends and stock, say, ZYX that does, if you're looking at a long-term option, a year down the road, 2 years down the road, you may have 4 dividend events or 6 or 8 or however long that option contract is. And each of those events are going to affect the options pricing on ZYX options, whereas XYZ is going to be unaffected, obviously. Exactly. So, yeah, very good point that it has the potential to, in fact, play a very major role in options pricing. All right, so let's circle back to what we were talking about earlier when we said that dividends are only paid to shareholders. So if you are an option holder, you won't get those dividends unless you become a shareholder. What does that process look like?
Yeah, so this is a really good question, and one that we one of the concepts that we continually drive home as far as our educational aspects surrounding options are the concepts of exercise and assignment, right? And we always talk about that. It's a big deal. It makes a big difference in, generally speaking, in people's P&L as far as how they trade options. And the reason why here is it's really important to understand that as an option holder, you are not automatically entitled to the dividends unless you convert that option to an underlying position. Now, I'm going to say that again because I think this is probably one of the most important things that you can take away from this podcast if you take one thing away. Stockholders get dividends. Option holders do not automatically get dividends. In order to receive a dividend, you need to convert your option into an underlying stock position. It's pretty simple. Now, generally speaking, the way that you're going to, and theoretically, the way that people create long stock positions most of the time from options is from being long calls. Let's take the example of the long call very simply. If you own a call, even if it's in the money at the time of the dividend being paid, it's not automatically exercised for you to get that dividend. You need to exercise that option and make sure that you are a stockholder on the record date instead of an option holder on the record date, because you actually don't get paid dividend if you only own the option and not the stock. So you need to actually tell your brokerage or trading firm that you want to actually exercise your option and convert it into an underlying position.
Okay. And so if your contract is expiring, let's say, after that dividend event, as a call holder, as we're using it as the example, you would need to proactively notify your trading firm that you want to exercise your contract. And in fact, to capture that dividend, you're going to be exercising it early or earlier than its expiration date. So that's where the early exercise comes in. So let's look at it from the option sellers, the call sellers perspective. How can they determine whether or not they're at risk of early assignment?
Yeah, another great question, and something that is one of those where the rubber meets the road situations, because when you're short calls, instead of being long calls, right, everyone remembers that options contain the right to exercise the option if you're long it, but you incur the obligation to fulfill that contract if you're short it. Well, if you're short that option, you don't get to control whether or not you're being assigned. What you do need to do from the position of someone who's short those options is try to be able to figure out when those options might have a higher probability of being exercised early. Let's say if the actual result of converting a long call into a long underlying position that includes the dividend is going to be advantageous to that call owner. And that's generally when you're going to see a situation where you're going to be in an increased likelihood of early exercise.
Right. Okay. So from the seller's perspective, how can they determine whether or not it would be advantageous for the call buyer to exercise that contract early?
So the way that I think about this, lots of people think about this differently, and it's taught differently in the options world as to, we're all kind of beneficiaries of information that's handed down, right?
Right. There's kind of two schools of thought. There's the investors' school of thought where they learn one way, talking about time value, which I know that you'll discuss in a second. And then the market makers' school of thought where they look at the value of the put. So do me a favor and explain both of those, please.
Okay. So let's look at the market maker value first. That's the one that I typically have used in the past. And the way that I think about this is, we consider the case where you have a long call that's in the money. Okay, it has an 85 or a 90 belt there or something. What you're really doing when you're long a call and you are actually deciding to exercise that call is that you're changing your position from being long calls to being flat calls. What that means is that you're essentially selling that call by de facto of exercising that process. You don't have that call in your position anymore. And so through the process of put call parity, what you're really doing in synthetic terms is you're actually selling the put that is on the same strike as the call that you're long. Now, this is a little bit confusing to some people because people don't always think about it in the investor world. as in the same way that we did as market makers, which is you're really looking at just inventory of how many calls and strikes and all of those things that you're long and short. But what you're really doing when you're exercising those calls, in our parlance, we called it punching the calls, right? Exercising the calls from a market maker, you call it punching them, because you're converting them into long underlying instead of long call positions. But what that really means is that you're actually synthetically selling that put. Now, if you're selling that put and the put is trading, let's say the put is trading $0.50 or something, you're going to want to make sure that you're getting more from the dividend that you're creating by creating this long stock position. You're getting more for that than you would be if you went and sold that put in the free market, right? So if the put's worth $0.50 and the dividend that you're going to get by converting your call into a long underlying position is 75 cents, generally speaking, most people are going to look at that and say, I want to exercise that call. Mm-hmm. Because when I exercise, I get 75 cents in dividend. I'm basically giving up the right, which I used to hold by owning the long call, to that synthetic put on the other side, but the put's only worth 50 cents anyway.
Right.
And so I'm getting more in return for the dividend than I'm actually selling the right for, which is what you're doing synthetically.
Right. And then from the individual investor standpoint, there's something similar where they look at the time value of the call. What does that look like?
The time value of the call is really what you're thinking about in terms of what is this worth to the marketplace for the amount of time that exists if I were to hold this all the way to expiration.
Right.
And how many days of that am I giving up by exercising this call now instead of waiting until it expires?
Mm-hmm.
And so you have to put a time premium value on that. And it all kind of comes full circle because really the time value of the call in that situation is represented by that same put that only has extrinsic value in it that doesn't have intrinsic value in it, mm-hmm. right? Those out of the money options are extrinsic value only and not intrinsic value. And so that's really how, like I said, it's kind of like two sides to the same coin in that way.
So 6 of one, half a dozen of the other.
It's how you look at it. And people like to talk about the time value being in that call, and they think about the actual premium being in the put. But it's all, put call parity keeps things in line.
Right.
So those two values are in there no matter what.
Right. So from the individual investor standpoint, they look at it and they say, okay, my call has 50 cents worth of time value in it, extrinsic value. Right. If I exercise, I'm going to lose that because I'm only going to get my strike price.
Exactly.
But if by losing that 50 cents of time value, I'm gaining a 75 cent dividend, they look at that as, all right, check mark, this makes sense. I'm going to go ahead and exercise early. So from the call seller's perspective, they can look at two things. They can look at the price of the put, as you had mentioned, or they can look at the extrinsic value, the time value in the call option, which when you look at the big picture, they're really the same thing.
Yeah, absolutely. Okay. It's two ways to say the same thing. And it's really, so I'm glad you mentioned the strike price because that's something that I didn't mention in the way that I described it. It's always important to remember when you're exercising, that's really where you need to, that's kind of step one, really, when you think about it, right? That's like, I'm going to, if I'm long the 50 call and I exercise the 50 call, I'm buying stock for $50.
Right. For the standard run-of-the-mill, non-adjusted option contract.
Exactly. Don't ever forget that.
Right. Now, that helps us segue into the next section. In the last section of our talk, I want to have a talk about regular dividends, ordinary dividends versus special or non-ordinary dividends. And the reason I say it's a nice segue is because those special dividends often get adjusted and are no longer may represent a standard option contract. So let's talk about this a little bit and let's look at it from a high-level overview because I know that you're going to be going into greater detail with this on your webinar. Let's talk about the difference between an ordinary dividend and a special dividend and how that might affect an options contract.
Yeah, that's a really good question. This is something that we get a lot of questions about on the investor education desk, and it's also something that is somewhat tricky for us to discuss because of the fact that every single corporate action, and remember, a dividend being paid is a corporate action. From the perspective of the OCC, every single corporate action is evaluated on a case-by-case basis. And so we get a lot of questions asking us, essentially, well, is this dividend going to be declared special?
And if it is going to be declared special, what is that adjustment going to look like?
What is that adjustment going to look like? Are you guys going to adjust the strike price? Are you going to do this? Are you going to do that? Now, the short answer to all of those questions is always, it's evaluated on a case-by-case basis.
Right. Therefore, we don't know.
So we don't know. The one thing that we can point to and that we use to point people to is an information memo that was published by OCC a while ago, number 31917. Now, what that does is it lays out in a little bit more detail how that case-by-case evaluation happens. And it gives you some guidelines as to what you might be able to consider as kind of like,
like a rule of thumb, maybe.
Yeah. A general rule of thumb as to where you might be able to put guidelines as far as what you think, as far as whether or not it's going to be declared special or whether or not it's going to be adjusted.
Right.
Now, from our perspective, we can't give you advice on whether or not it's going to be adjusted or whether or not it's going to be a special dividend. What we do encourage people to do is go to the website, go to that information memo search page at optionseducation.org, and look at the history of how those things have happened. Do some education for yourself as far as looking at how and when and whether or not things have been declared special or been adjusted. Specifically, the best part about that information memo search page is that you can search it by security name. You can search it by information memo number name. You can do it's an infinitely kind of customizable search.
Right. I do want to interject for a second. The website address is actually www.theocc.com, THEOCC.com.
Yeah.
The one that Matt mentioned, optionseducation.org, that's the education website that we have for OIC.
Yeah.
But Matt, your point is that this 31917 lays out some of the groundwork as to the differences between an ordinary versus non-ordinary or special. The reasoning for why an adjustment might be necessary. Typically an ordinary dividend is known months in advance.
Yeah. And
the market has a chance to price that dividend into options pricing. Special dividends, non-ordinary dividends, sometimes those come up immediately. They're announced. The record date is going to be in a few days, the payable date, et cetera, et cetera. So the market doesn't really have time to react to that. But going beyond that, the memo that you mentioned again on our website, theocc.com, the number is 31917, talks about if an adjustment is warranted, how is that going to look? As you had mentioned earlier, reduction of the strike prices. But the information is there on the website, a great way to research some of the methods. So definitely a terrific resource and something that investors might want to familiarize themselves with. Because as you had mentioned from at the beginning of the segment, probably the most often questions that we get asked, they're all about contract adjustments, and dividends or special cash dividends certainly is a major contributor to that kind of volume that we get here at the desk. So, Matt, absolutely. Thanks for that information. Very, very wonderful to hear and meet with you again. Thank you for joining me. And thank you to all of our listeners and supporters out there. Before we sign off, I want to encourage you to register for Matt's upcoming OIC webinar, which he will take a closer look at the ABCs of dividends, if you will, including a deeper dive into the concepts that we discussed today. You can register on OIC's website at www.optionseducation.org to attend the live presentation, or you can view it on demand as well. And as always, please feel free to send your questions to us via email at options@theocc.com or live chat with us on our website. Thanks again to all those listening. Matt, thank you for joining us again today.
Yeah, thanks for having me.
We'll be talking with all of you again very, very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.